One of the biggest mistakes real estate investors make isn't buying the wrong property. It's buying in the wrong city. Yeah, location right now is the biggest thing that any investor, in my opinion, should be focused on. Yeah, obviously your asset class, what's your criteria, that's important as well. But what we're seeing undeniably is in some cities and some markets, a bunch more crime, a bunch more negative aspects happening in some cities. So one of the things we're looking for, you guys, and where we're looking to buy new deals, new locations, is we're looking for submarkets that have a very high 1 mile median income. And what that tells us is when we get into an asset, we now know what that tenant profile can pay. We now know what that tenant profile's habits are. Because whenever you buy real estate, specifically multifamily, I'm focused on here, you're buying a tenant profile that's your customer. So when you drive around a submarket, just notice and observe the cars you see, the restaurants, the retail, everything you see, that is your customer. And that's who is going to be showing up and walking through the door. And so I'll tell you firsthand, you guys, one of the hardest lessons we learned in this recession, locations with a lot of crime and low 1 mile median income were by far the most difficult to manage and had by far the most pain in value. So if you're getting into multifamily and you're looking to invest in deals, the question I would ask you is, are you aligned with your customer? Are you aligned with their core values? Do you understand who your customer truly is? Do you understand how they're going to behave when things change? Because as we saw the market shift, go back to 2020 when it was COVID time, right? We were all getting these checks in the mail, specifically our residents. Money shows up in their inbox, and now they're using some of it to have fun, but pay rent. And what happens is as you start to feed a population, just like they say, don't feed the birds, don't feed the animals. When you give money to people, it makes them dependent, not independent. This comes back to something with my children too. I tell my wife all the time, I don't care how much money we make, we can't give our children money, because if we give it to them, they will become dependent and it'll ruin their drive. And as much as it hurts and as much as you want to, because you want to, it's so easy to give it. You're like, you got plenty, let's just give it to them, give them, make them happy. It may be short-term happiness, but long-term there's pain. We saw that in one of our assets tremendously. When COVID money stopped, the habits of the people were not to go back to work and get a job. It was to go to work the system. How can we live here for free? What can we do with the laws that are changing to be able to hunker down and not get evicted? How do we go down to the courts where some of these cities were hiring lawyers to help residents stay in their properties? It's very dangerous. It's very scary. So the most important thing that we're looking at right now, far and away, because as we look at our 22 assets, and I had a front row seat managing these deals because I'm still in the business, still in the work. As I'm watching front row seat, we're seeing assets behaving very differently, extremely differently, like night and day difference. And the ones that were struggling the most were our low income properties, especially the ones that were purchased in 21. So you get this low income tenant profile, COVID money leaves, they're now not paying rent, and your delinquency starts to climb. You evict as fast as you can. There's laws in place. You can't evict potentially. It's a very dangerous place to be as an investor. And what happens is when those tenants don't pay rent, now you don't have any extra money to keep the property nice. Now you've got deferred maintenance stacking. Now you've got attraction of even lower quality tenants that have been evicted, and you're having to potentially take people that you don't want to take because you're desperate for capital. Not a place you want to be. It's a downward spiral. And so while I'm watching front row seat, we've got other assets that are just taking off. They're doing really well. NOI is growing. Yeah, interest rates are rising. Yeah, cap rates are rising, so value is actually coming down, but NOI is still in a growth mode. And what has been the separator, hands down, far and away, is locations with a really high client profile, 1 mile median income, perform much better through the volatile times. And generally these locations are much safer. So you don't have as much crime, you don't have as much theft, you don't have tenant profiles trying to work the system, they care about their credit, and it allows you to push NOI much faster and be much more stable for a base hit return on a really nice asset as well, much less deferred maintenance. And look, I know a lot of you are watching this at different stages, and for those of you that are just learning, that's great. Keep watching, grab the free blueprint, educate yourself. But some of you are past that. You already know know this makes sense conceptually. You just need someone to look at your specific numbers and tell you what actually applies. That's what our capital positioning call is for. If you're an accredited investor and you want to have a conversation with my team about how your capital is positioned and what real estate could look like in your portfolio, we've got a few spots open this quarter. Links down below. The states we're looking to avoid, you guys, in cities are Seattle, Portland, San Francisco, New York, parts and most of Minneapolis. These states, how do you, if you can't evict a tenant, how do you control or help pay for the residents that are paying rent, right? You've got some people that are paying rent, but if a lot of them are not, now the ones that are paying rent, it's not fair to them because we can't keep the property nice. We can't keep the crime off the property because you can't hire security. And so if you're buying in markets that have a lot of tenant-friendly laws, you're going to struggle. That's how it occurs to us. Now, if you buy a really, really nice property at the right timing of market, can you do well in California or Portland or Seattle? Sure, it's possible. I'm not saying you can't make money in any of these markets. That's just not for us. We're looking for high cash flow. We're looking for business-friendly states. We're looking for job growth. And generally what we're seeing is a lot of businesses, a lot of people leaving these states that are not business friendly, and the business just hops over a state, and then you see the people follow. Like, we track one-way trips for U-Haul, and for the last 2 years in a row, the most incoming one-way trips from U-Haul has been Dallas, Texas. That's purely because of jobs, you know, and you get stuff happening like you have happened in New York. We're business owners. We want to do well. We want to provide for our families. We want to make a beautiful place. But if you're handcuffed or you've got laws against you and you can't perform, you got to leave. Otherwise, you're going to lose. You're going to die. And I can tell you, business owners, they're not easy to just lay down and die. Business owners are business owners because their mindset is bulletproof and they've got unique ways of looking and doing things, and they are not going to lay down and just end it. Otherwise, they wouldn't own the business. And so we like to be in those states that are very, very business friendly, very landlord friendly. Helps us get into a place of cash flow as well. The Midwest, the Sun Belt market, we're looking for higher than average cap rates. Number one criteria for us is, does it cash flow day one? If you've got cash flow right now, you don't have to sell. The people that have to sell, they don't have any cash flow, and they're feeding their deals 30, 50, 80, 100 grand a month. And the bank is over here saying, yeah, either you sell it or we're coming after you with recourse potentially, right? Or they're just got to sell at a loss and they get their equity wiped. So if you got cash flow, you got this safety net, you can hold on. You don't really care what the market's doing. If you're getting 7-8% cash flow right now and your value's down, does it matter? Not at all. Doesn't matter, because you're not exiting right now. And with the way currency is printed, and you look at every currency in the history of the world, everyone, 100% of them has either gone to zero or been replaced. You can pretty much say the future of the dollar is not very bright. That's how we're selecting markets, is we're looking for very high 1 mile median household income. We are looking for very nice retail shops. We're buying a property right now, Hathaway at Willow Bend, located in Plano, Texas. Right across the street, you got Whole Foods, you got Williams-Sonoma, Sephora, you've got Marshall, you got Starbucks, you got, REI, Trader Joe's, you got all these shops my wife loves to shop at. And I can tell you right now, if you've got those shops across the street, it attracts a very specific clientele. And the other piece, you guys, that I'll share with you on location is, if you can get into a submarket where the average home price is 6, 7, 800 grand, like a property we're buying here, Hathaway at Willow Bend, the average home value in a 1 mile radius is $777,000. And so if you want to attend the Plano School District, which by the way is rated A on niche.com, which everyone wants their kids to go in a healthy, safe school, right? The way you can get into that school without buying an $800,000 home is to rent at our apartment. And what you'll find when you get those types of locations is you'll find that people live there for a very long time. We've did our lease audit and we look at the rent roll, and in that lease audit, we can see people have been there for 12 to 15 years. That is not common, and it's a lot of people. That's home for them. That's where they live. That is not where we're just hanging out for a year and maybe 6 months and moving on and can we find the next place. This is home. And the reason is because of the location, because of the shopping, because of the schools, because of the safety, because of the freeways. All of that has massive, massive impact. And the last thing you guys want to look for when you're looking for locations is for there's not a bunch of new supply coming. And by the way, there's 0 units coming for the next 2 years, 0. And the submarket's already at 95% occupancy. So it's going to put pressure on rents because it's a supply demand game. The other thing is where can they build this product in your submarket? And if there is nowhere to build it and it's not happening, which that's exactly what you have here, you have this perfect storm of buying at a low price. You put in nice fixed debt at 70% leverage, very healthy number, and you got this very likely chance of massive rent growth because there's no more units coming. It's a location everyone wants to be at with amazing retail right across the street. If you're starting out and you want to do this, what I'd be looking for is, if I'm going to do it alone, how much capital do I have? Because that's going to dictate what you can buy. So for me, in the beginning, when I was in my snowboarding career, I remember I bought a duplex and I put 25 grand of my own capital into that deal. And the reason I bought the duplex is because I only had 25 grand at that time. Then I bought a 9plex and I put in 65K. Again, this is 2012, so very different time and very different market. This is up here in Washington State. Deals I wouldn't buy anymore. My criteria shifted, but doesn't mean you can't do well. If you get an asset that you can underwrite, and you want to have some underwriting tool, you want to be able to put your income in, you want to be able to put your debt in, you want to be able to put your current rent in and what you think you can get for pro forma if you're going to do any value add strategies, right? You want to have your expenses dialed and work with your property management company, you guys, by the way, on that. If you're buying a property and you are underwriting it, go sit with the regional, go sit with the person in charge of that little submarket and say, hey, I'm looking at buying this 9-unit property. Here's what I think I can move rents to. Can you help confirm that? And if they're good and they manage this type of asset in this type of location, they can look through their portfolio and look at other competitors. They can help you verify you've got great comps, because the comps are going to dictate what you can do with any property. So you want to be tuned into the comps with your property management company to project your rent and your business plan to make sure they believe in it, especially if you're going to have them manage it. Because the day they take over, if you used to go and hire them, then they're going to look at your underwriting and they might say that's not possible. And yeah, that CapEx plan's not what this tenant profile needs. So you want to bring that property management company in really, really early. The other thing you want to do is you want to have your expenses dialed in with them. And they're going to be able to look at their portfolio again, or they just have much more experience than you if you're just getting going. Because if you're just getting going, how do you project what your trash is going to be? Yeah, you could add 3%, but maybe there's a law in there where every 5 years there's a contract that resets, or your water, I think it'll go up 4%. Well, it resets every this year. Your property taxes, your insurance, there's a lot to it. And you don't want to be doing this alone. That's another piece I would tell people who are just getting going. You don't have to do this alone. I'll say the best team in real estate wins. I look at what we're doing, and we've kissed a lot of frogs to find some really, really great property management companies. So I have been through a lot of pain. But if you can get a great property manager that really knows the asset class you're buying, and they can help you get your underwriting set up before you close, you're 10 steps ahead of the average investor. Because the average investor, they're doing the best they can to come up with it on their own. They have a little capital on the side for CapEx where they didn't do a thorough due diligence. And I'm telling you guys right now, get that thorough due diligence with your property management team. Get them on site with you. Have them help you analyze the deferred maintenance. If you don't have someone there with a trained eye, and I didn't do this in the beginning, you guys, I didn't have a trained eye there with me. I didn't have a vendor double checking my work. I thought I knew. And again, I got lucky because my timing was right. It was 2012 and I didn't hold these assets very long. But the mistake, dodge that mistake. Do not go do this alone. Get a great CPA on your team to help you quarterback your finances. Get a great property management company on your team to help you underwrite your income and expenses. Make sure your debt broker is accurate with what they're going to be able to perform on. And if you don't have these people, reach out to us. It's easy to reach out and say, hey, I'm looking for a vendor. Do you have anybody? And we have a lot of contacts in a lot of different markets. It's very easy to help find team members that are great, and they're not all created equal. By the way, if this is clicking for you and you want the full picture of how this works from a tax perspective, I have a free blueprint that lays the whole thing out, just the framework. Links below, it's free. The deal we're buying today, you guys, it's the same real estate, same units. It's just a unique time to be buying. Yeah, timing is the separator. You look at the asset we're buying right now in 2026, same real estate, same units, actually a rougher property, but it's a much better buy because of the timing, purely because of the timing. 6 years ago, the property was purchased with variable rate debt leveraged to the moon, where they ended up paying $6.5 million more than what we're paying for here 5 years later. So the timing of an asset is critical, whether it's Bitcoin, gold and silver, real estate, it does matter. It definitely does matter. And for you to not have an idea of where you're in the cycle, that would be the piece I think about the most when I go back of, I don't hear people talk about it a lot, and it needs to be talked about more, is where are you in the cycle for that asset class? And every asset class cycles, right? Bitcoin appears to be on this 4-year cycle. Real estate's on an 18 3/4 year rhythm. And so one thing that's critical is to understand where you are about in the cycle. And for timing wise right now, with multifamily, you can pretty much say you're at the bottom or very close to the bottom purely because of supply and demand, interest rates, and the lack of people being able to buy, which causes people forced to sell. And when they're forced to sell, they take any price they can because they just have to get out. That's a perfect time. That's capitulation time. When people are forced to sell, I don't care what it takes, just get me out of this thing. And you just offer, maybe you have to retrade, because you find some things and they agree to it. It's a time to be greedy. It's a time, go back to Warren Buffett's comment that he's classic about, when people are fearful, be greedy. And right now I can tell you there's a lot of fear in the market. But if you focus on the data and you don't look back of, in 21 and 22, I got this pain. You look at what the data says now, looking forward, get on the front of the ship and look out to sea. You'll see a totally different world than if you look back at the storm that just passed. And so I think that's the separator right now. Groups that know what they're doing and are tuned into the data, because the data doesn't lie. You tune into the data and you see what's coming. There's a lot of excitement. There's a lot of froth at people for buying right now, where if you're looking at the past and you keep talking about the past and looking at the pain and focus that way, you're likely going to miss the ship. You're going to miss the opportunity. The story on this deal that we're currently buying is back in 2021. They bought it with bridge debt. They paid $6.5 million more than what we're paying for it today. And as interest rates ran with a variable rate loan, they had to start feeding all of their cash flow plus CapEx into the loan to keep the deal. And the hope for them and many others was, well, rates will come down and we're going to hold on. And when rates come down, then we'll refinance and the whole world will be good. But rates didn't come down. And so it got to a point where now the seller is forced to sell. In order to get a deal like we're buying 229 units in an A location, you have to have a bit of a track record. You have to have a relationship with these brokers. And so our team in 2025, actually, we underwrote 344 deals. The reason for passing from our team, I asked for a little chart. They said 37 were cap rate issues, 23 had too high of delinquency, 228 just didn't fit our characteristics for our criteria, and then 44 were locations. And so we submitted 12 LOIs and we bought 2. And that's kind of where we are right now in this market. It's cherry picking the best locations. And so when we find something that's close on our numbers and the relationship with the broker is strong, we'll get close with them and connect. Hey, we really like this deal a lot. We haven't bought anything for the last 6 months. Our team is fully focused on this asset. We're close on your whisper price. Sure, you're not going to give away the farm, but you're going to go into this negotiation period of potentially a best and final if it's fully marketed. If it's not listed, you might just be back and forth with the broker. And at that time, you've got to be really clear. Focus on your numbers right now. Your numbers are going to tell you the valuation, because the way these deals come up is they'll often be listed with a brokerage firm or off-market phone call from a broker, which still may be marketed to some extent, but they'll say it's off-market. And you're going to basically, submit an offer, and they may not tell you. They might give you a whisper price. The whisper price on this thing was $42 million. Well, that doesn't really mean anything. I get it. That's what the buyer would love on the best day, sunniest day in this market. And I don't think there were many people above 40, and I don't think there actually were any above 40 realistically. So you got to create your value, your price based on the numbers. And if you don't know what you're doing, don't buy. You're not ready yet. Go get educated. Reach out to people. Look for a mentoring program to really understand how to underwrite and analyze these deals. And so as we go back and forth, we ended up getting the best and final. We've got some connections in the industry that know people really well that helped us get comfortable with our max price where we were. And then at that point, you just hold the ground and you just say, this is what we can do. And you keep looking for many other options and opportunities. You don't get emotionally tied to anything right now and ever with that matter, because emotions kill your deals. So you submit your offer and you keep looking until they come back and let them know, we love to buy, we'll buy at that price, but we can't pay anymore. And then you get the deal awarded to you. It's kind of this moment of sweet, we actually got something. And then the very next question is, what are we going to find on due diligence? We know the property hasn't had the capital it's needed. We find too much, we're going to have to retrade. And a retrade you don't want to do ever. Right? We're not out to retrade anybody. But if you go through due diligence and you find an extra $1 million or $2 million of deferred maintenance, someone's got to pay for that. And as soon as you sign on the dotted line, that is now your bill. And so that affects your underwriting. And in this market, I'd say 80% of deals are being retraded right now. Back in 2019, 2020, 2021. It was unheard of. And if you did it, brokers basically badmouthed you because they had all this leverage. The brokers were like, if you're going to retrade us, we'll never sell you another deal. So there are politics in this market. There are strongholds in this market. There are things going on, and to be aware of them and don't let them in. And so that's how we ended up getting this deal awarded to us. And luckily during due diligence, we had the correct CapEx budgeted. We had a lot of CapEx budgeted. And so we're sitting in a good spot on that. If you want to see why we're buying this deal and you want to see us walking through the asset, you can watch this video next.